Hey everyone, it's Terry coming to you from Invest Roundup. There's a silent stock in the US tech stock scene at the moment, and there's a good chance you've never even heard of them. Unlike Tesla, who just officially joined the S&P 500 this week and made a bunch of Tesla-nares. That's right, it's a word. Meanwhile, US Home Depot is battling it out with Lowe's to be the stock market darling, and it looks like it's going to go on for a while. But it seems like experts have already taken their pick. And speaking of picking, streaming giant Netflix went for a little spin in the stock market last week, and I've got to say, that is an impressive company. Well, let's find out more and get into this week's news. Disclaimer: whatever stock or news we talk about is not a recommendation to buy or to sell. These are all just news we deem important, things we think you need to know about if you're invested in the stock market or if you intend to invest. First news item, we talk about the Tesla revolution. Tesla's back must be aching right now because it is carrying a huge chunk of the S&P 500 on its back. The electrical vehicle company joined the S&P 500 last week, accounting for 1.69% of the entire S&P 500, which makes it the 5th largest in the index. This means, according to the index analyst, for every $11.11 Tesla moves, the S&P 500 changes 1 point. There was a frenzy last week when investors rushed into Tesla shares into the final run-up and pushed the stock up nearly 6% on Friday. The share then closed at an all-time high of $695 per share. If you want to talk about a dramatic entrance, this is it. The company has had 5 consecutive profitable quarters now thanks to the heightened demand for electric vehicles this year, and their share prices have also been responding well to these profits, having increased more than 730% this year. This chart from Bloomberg also shows that if you've invested $5,794 back in 2010, your shares would be a whopping $1 million today. Now, if you're thinking just what is up with electric vehicles and why is it so popular in the stock market recently, here's the thing. It's not about electric vehicles anymore. Just like how Apple isn't just about the iPhone anymore, the EV industry isn't just about the cars either. It's about the platforms now. What are the other things that can ride on this wave and prosper together with it? And let me tell you, there are countless, I repeat, countless ways to profit from this boom. The industry is still in its infancy, and like the Tesla-nares, early investors will be the biggest winners. Battery metal producers, for example, like Lithium Americas and Galaxy Resources, charging stations like Blink Charging, chip makers like Nvidia, tech platforms like FaceDrive with its electric car on-demand service, and food delivery businesses. Even in China, a newcomer on the scene, Li Auto, that is currently listed on Nasdaq, is also quickly making waves on Wall Street. So, get ready to be electrified. Second news item, the stock market hits home. US Home Depot Incorporated has been receiving a lot of attention in the last few months due to its price movements on the New York Stock Exchange. For instance, there was that time when it increased to $290 at one point and then dropped to the lows of $262. Some institutions are expecting the company to grow by 18% over the next couple of years, and it looks like higher cash flow is also on the cards, which should then value the shares higher. Basically, positive outlooks. In fact, if you ask me, it's common sense. The whole world is on some form of lockdown right now, and when you're kept indoors, you start hunting for things to do. And home improvement is definitely a good way to kill time. Hence, home improvement retailers like Home Depot, Lowe's and IKEA would benefit. Basically, there are broad trends taking place in this segment right now that are boosting its securities. That said though, investors are still divided whether to go for Lowe's or Home Depot. Lowe's has stolen the spotlight last week when they announced a boost in their share repurchase efforts by $15 billion, a sign of confidence in a business that has been booming in 2020. And the market responded strongly to this because their shares climbed by 6%. An article in Seeking Alpha though maintained that Home Depot would be the more decent pick in the strong industry, and that Home Depot's valuation relative to its peers points at a better risk-to-reward dynamic. The firm has been seeing solid earnings estimate revisions over the past month, suggesting analysts are becoming a bit more bullish on the firm's prospects in both the short and long term. They've also been adapting well to the high demand environment, not to mention their good interconnected retail strategy and underlying technology infrastructure has also helped boost web traffic in the past 6 months. Amid all of the optimism though, it is worth noting that Home Depot does have high levels of debt and significant insider selling activities over the past 3 months. But one question remains. When the lockdown is over and people are no longer staying at home, will Home Depot continue to thrive? At the moment, Home Depot is considered to be a low-risk investment. By the way, before we go on to the next news item, click on the subscribe button below now so you will be informed the next time we upload a new episode. This way, you won't miss any important market news. Third news item, is Netflix still a great investment? In case you haven't noticed, Netflix and chill just got way more attractive this year since everyone had to stay indoors, which probably explains why the company's stock have also been looking rather attractive to investors. They even made it to the Street.com's list of top 25 stocks of the year, ranking at number 5. The stock for the streaming service went through a rollercoaster early last week and went through a rotation when it went up by 3.8% last Monday, to $521.50 and down again by about 1% on Tuesday. But that's not a major concern because just this year alone, the streaming media giant's stock is already up by 65% and the company is currently worth $236 billion with nearly 200 million subscribers. It's hard to believe that just earlier this year, the very same company was knocked from the record high of $393 at the start of March to only $290 2 weeks later. The company had to battle bandwidth issues when the whole world was suddenly streaming content at the same time due to the lockdown. And to complicate matters, Netflix competitor Disney launched Disney Plus, which features popular content from Marvel, Star Wars and Pixar among others, for just less than half the cost of Netflix. Apple TV Plus launched star-studded shows and big-budget projects, all at a competitive price. And it was free to Apple device buyers. But somehow, Netflix recently pulled through. Despite the seemingly rosy outlook for this streaming service though, experts are advising Netflix investors to consider if the recent slowdown in subscriber growth is temporary or permanent, especially now that the economy is slowly opening up around the world, which means less screen time. Nonetheless, you have to admit they are a strong bunch. I mean, come on. After battling issues with their bandwidth, furious assaults from new competitors, they still managed to raise prices yet again. That's an impressive feat right there. Bullish investors are now waiting with bated breath to see if Netflix will rally one last time before 2021 rings in, even though it's currently already above its intrinsic value of $412.70. And finally, we look at a stealthy stock market winner no one has been talking about. While the stock market is abuzz with news about Tesla, Amazon and Zoom, in the background walks a silent winner. Only one US tech stock has outperformed Zoom this year, and it's not a cloud company. And its name is Digital Turbine. Long story short, this company is a 22-year-old mobile phone software provider from Austin, Texas. And without most people noticing, the company's stock has climbed 573% in 2020 alone, topping Zoom's 487% gain as of last Tuesday's close. Just at the start of this year, their market cap was just a little over $600 million. It's now standing at a whopping $4.3 billion. Year to date, Digital Turbine Incorporated stock has gained 558.2%. Ex-fund manager and Mad Money host Jim Cramer had also described this stock to be hot as a pistol. Equity firms and investment blogs have also been bullish about this stock and marking it as one of their to-watch stock. So, why the sudden popularity, you might ask? Well, according to Yahoo Finance, it is simply a case of increased investor discovery due to its great positioning in the world of digital advertising. So it is true what they say in value investing. If the business is good enough, the share price will soon catch up. As of today, the company's growth and profitability looks solid. Only thing to note is, if you're looking for passive income, this company is not big on dividends. Looks like we have a new tech stock to watch out for in 2021. And those are the 4 important investment news we had to share with you this week. Once again, we encourage you to get more information if you'd like to act on any of the companies we've shared about earlier. Comment below and tell us what you'd like to see on Invest Roundup and share this video with your friends, especially those who are vested in the stock market. Here's to a very Merry Christmas from the Invest Roundup team, and we'll see you next week.